Thank you. My name is Kealan Doyle. I'm co-founder of Symvan Capital. And what do I hit here? Is it the arrow? There we go. We are a fund manager who have two SCIS funds open now, one a technology fund, one a gaming fund, and our evergreen EIS fund. We are very much in the area of technology, B2B. We have been maintained a philosophy as we have for the last 5 years. Although we're mostly B2B, we do, I think, have two investments that are B2C, but our focus is very much B2B. We're interested in things like blockchain, fintech, HR tech. We've, as mentioned, we've won a few awards. We tend to be nominated these days for SCIS and EIS Best Fund Manager, and sometimes win it, and sometimes not. Let me play this. This is a recent investment in the area of wealth management tech. So I didn't get a chance to introduce these guys, but they're basically a company we invested in last year. They're integrated quite considerably into St. James Place. And what they're basically doing, like a classic tech company, is taking a lot of the costs out. As all of you know as wealth managers, you've got, particularly with an FCA burden that grows by the day, you've got quite a bit of cost structure that can be automated and be taken out. And that's what these guys do. Now, they have been recently shown, they're being rolled out in the St. James Place network. It's the top producers at Merrill Lynch, they used to call them Chairman's Club. I don't know what they call them at St. James Place, but the sort of top 20%, the classic Lorenz curve. They've been doing very well. They're getting a lot of traction, and they're a classic example of what we look for in a company. As I say, fintech is something we think we know a little bit about. We really like these guys. We think it's a global opportunity, and it's certainly something, if any of you want to talk about, please come and have a word. But what I'd like to talk about, so this is a company that we've used our SCIS and our EIS. Our SCIS doesn't look for conceptual. We're looking at sort of late seed. Our SCIS investments in the last year tend to have a few $100,000 in revenues. They're in areas like cybersecurity, like fintech, like immersive technologies, VR and AR, et cetera. Since time is tight, I thought what I'd, now, just to go back to digital clipboard for a second, one of the things that's interesting about both of these investments is that they're both classical tech plays in that they both pivoted. So Digital Clipboard originally was looking to solve a problem in the medical devices area and pivoted towards a wealth management solution, and looks like they're getting some real traction here. This is a company we recently sold to our company, Buying Butler. It was our first investment in 2014. We started selling it at Q1 last year and completed at the end of the year. It was much delayed. It really is an anatomy of an exit. We grew it from two guys, grew it to about 50 developers at one point. Since have pared back. Classic case of where they pivoted towards a solution and made all the difference. In this case, towards the insurance claims industry. So insurance is a very interesting area. It's a massive industry. It's completely inefficient, and everybody needs it. Perfect for tech disruption. It's writing down for anybody who's in insurance is quite a name brand. They've created a brand. Our guys provided the technology, and hence that led to the merger. Now, when I say it was a bit of a rocky road, what I mean by that is the two co-founders, one of them passed away, unfortunately, and quite tragically last April, and we needed to bring in a new CEO to point this company towards where we think it can get, and it can really grow. It is at present, if you look at the Intelligent Partnership EIS guide for this year, you'll see 3 exits. One is Seneca, the other is one discussed earlier, Par Equity's 70 plus exit, and ours, which at present is less than a 2x. But I think why it was included is because the potential is huge. They just signed, well, they've signed a number of POCs, but the big contract that they signed last year was a group called SafeLight. SafeLight is the largest automobile claims manufacturer in the United States. These guys are bringing their cost base down by 90%. 90%. Now that's a big market. That's just one customer. So to put that in, what does that mean for the bottom line? In this case, and it's why it goes to C-level in terms of this, the priority for this, is removing hundreds of millions in costs for this group. What does that mean for writing down? Well, it's, and by the way, it's a company that is in our current portfolio. It's in a place where it could possibly, if it took all of the claims, and I'm not saying that could happen, but if it did, it would be generating revenues of 50 million. At a multiple that you can get achieved in the United States, that's definitely a company that's worth a few hundred million. Now, this is a company that's also getting a lot of traction in Europe. They've got all of the major, the largest Italian insurer, one of the largest German, and many else throughout the globe. One of the things that's interesting about this, it really does show, and a few people have highlighted this, is by getting in early and growing with the company. One of the reasons we started how you can get this great return, one of the reasons we started looking at SEIS is because we like to get companies at a very early stage because we want to de-risk our EIS. When we first started off in this business, most people were talking about returns of £1.10 on a pound. We used to do these intelligent partnership roadshows, and we were definitely the outlier talking about 285 per £1. But part of our pitch was, and it remains so, is that we de-risk our EIS by our SEIS proposition. Now, as it happens, our SEIS out of 20 investments that we've had thus far, we've had one failure representing less than 1% of the assets. I do anticipate that to rise, and in fact, if you look at our calculations, the 285 is based on a 50% attrition rate. We don't think we'll get anywhere near that, which is why we think the target, which is a IRR in the mid-20s, we can probably surpass that. So with that, I'm probably the shortest presentation here, but I'm the last one, so thank you very much.